Bank is the one that we want to focus on. Disappointed in the first quarter, asset quality deteriorated, which dragged profits. Came as a surprise. Let's just put the numbers out first, and then we'll bring in the analyst. Gaurav, take it away.
Well, yes, Axis Bank actually reported weak set of numbers. It was actually expected to report weak set of numbers, but the numbers that they reported were weaker than what the expectations were. Now, first, let's talk about numbers. Net interest margins declined almost by 17 basis points. Now, the street was expecting this decline somewhere in the range of 10 to 12 basis points. Another disappointment was the asset quality. Now, Axis Bank has actually upgraded their provisioning norms, and that is the reason there is a technical impact in this quarter. But this technical impact costed almost 620 crore rupees on its profitability. So when it comes to provisioning, around 800 crores of impact is what we have seen because of this technical changes that the Axis Bank has done. And that is the reason why we talk about credit cost that has also gone up almost to 1.4%. Same trend was seen in slippages as well. Slippages came in at around 8,200 crore rupees. And if we exclude this technical impact, slippages would have been around 5,400 crore rupees. So a huge impact is what we saw in slippages as well. As a result, profitability came down almost by 4% on a year-on-year basis. Now, bank highlighted that there was a 600 crores of impact on profitability because of this technical impact. At the same time, if we quantify this impact, ROAs declined almost by 15 basis points and ROEs declined almost by 1.4%. So without these technical impacts, the ROAs would have been better almost by 15 basis points. Another point to highlight is that the loan book growth has been slowing down now. Management is saying that the loan book growth will pick up and it will be higher than the industry in the medium term. On the other hand, they are also saying that the slippages are likely to come down because there will be recoveries in the coming quarters. So they expect slippages to remain muted for the next 3 or 4 quarters, and the recoveries will actually help credit cost to come down. But what Street is also penciling in and what analysts are also saying is that the slowdown is going to be there in the loan book. They're expecting 10 to 12% growth in the loan, and at the same time, because of the valuation comfort, they are actually maintaining their buy. But we are seeing target price cut across the brokerages. We have seen Investec, IIFL cutting down their target price. So definitely a negative impact is what we're expecting on the share price as well. And weak set of number is what we have seen in Q1 from Axis Bank.
Okay, all right. Thanks a lot for joining in, Gaurav, and explaining that very, very crisply to us. Let's get a view then coming in. We have Ajit Kumar, lead BFSI research analyst at JM Financial, who joins us on the show. Hi, Ajit. Good morning. Thanks a lot for joining in this Friday morning. Axis Bank, things not looking too good, for shareholders out there. But the stock as it is has underperformed in the last 1 month. It's as it is down close to 5%, while the Nifty Bank is up 2%. And now we're bracing for another 4-5% cut. Do you think the street will look through this technical write-off, or do you think there are other reasons to be concerned out here? Your view.
Good morning, everyone. Thanks for having me. So yes, Axis Bank has given a disappointing set of numbers in 1Q26. But just 2 to 3 things I wanted to highlight here. On the operational side, everything was broadly in line. So like, for example, loan growth of 12% YOY, NIM decline of 12-13 basis point adjusting for the interest income reversal. Both of these were in line with our estimates. In fact, operating profit, PPOP, was 4% above our estimate due to higher treasury gain. So operational side, things were in line with the estimates. Yes, on the asset quality side, there were additional slippages of around 2,500 crores due to the accounting change done by them. But here we have to remember that more than 80% of these additional slippages are secured in nature. And since it is secured in nature, we will see some bit of recovery coming out of these additional slippages in the later part of the year. So yes, these additional slippages are negative in nature, but at the same time, we need to remember that since more than 80% is secured in nature, recoveries are going to happen in the second half of the year. The other point I wanted to highlight here is, if you look at the valuation of Axis Bank, right? Currently, it is trading at 1 standard deviation below historical mean, right? And if you compare Axis Bank with some of the other banks on all the operating matrices, despite the soft quarter, is actually much, much better. So while, this is a disappointing quarter, but having said that, this is not the end of the road. We continue to like the name. We remain, buy with unchanged target price of 1,000.
Yeah. So you would be looking to buy the dip today?
Yeah, correct.
Okay. Ajay, just curious. Hi, morning, Surabhi here. Just curious. Wonder why the bank moved to do this. I know their explanation is that they are just being extremely prudent. But had they indicated this to the analyst community in earlier calls, that they're going to change their NPA recognition practice?
Not much, Surabhi, but having said that, there are few other lenders who are actually tightening their, recognition criteria, whether it is bank, whether it is NBFC. We have seen, two or three, lenders doing the similar stuff in last 1 or 2 quarters. So it's on a prudent line. While it is disappointing in the near term, but I believe, over a longer period of time, this is a prudent move.
It's a healthy. Okay, so fine, I take your point, and that's exactly the argument the bank is making, that it's just a cleaner, healthier book over the long term, and they've realized all the impact one shot in the first quarter. So let's move beyond the NPA conversation. But even then, I mean, margins, look at the margin fall, I think 17 bips thereabouts, a little more than what the street had in mind. Loan growth is about 8%. Again, not really, lighting up the charts. What about those parameters, margins and growth?
Well, so the numbers are soft, but this is going to be the trend across the financials in this quarter. When the sector loan growth itself is 9.5%, we can't expect the large banks to outperform them materially. And these numbers were broadly in line with the estimate. So loan growth of 12% YOY was exactly in line with our numbers. Yes, there is a margin decline of 17 basis point, which is higher than, let's say, 12, 13 basis point that the street was penciling in. But at the same time, we have to remember that within that 17 basis point Q&Q decline, there are impact of interest reversals. So if you exclude that, because there were additional slippages, right, in this quarter, and due to that, there were interest income reversal that happened. If you exclude that, the margin decline was roughly 12 to 13 basis point Q&Q, which was again in line with the estimate. So I'm not that much disappointed with the operational numbers. But yes, on the asset quality side, there is some bit of disappointment as far as these additional slippages are concerned.
Ajit, let me ask you this for our viewers, right? Earnings are still coming in. Anything you'd like to position yourself for where, in terms of tactically speaking, where you think numbers could be, could surprise one way or the other out of your coverage universe?
Yeah. So, in such kind of scenario where loan growth is not there at the sectoral level itself, as I said, 9.5% credit growth, asset quality is not completely out of woods, and there are margin pressure which is coming through. In such kind of scenario, our preference is more towards the larger names, more safer bets, whether it is banks, whether it is NBFC, and that is why we stick to larger private sector bank or even SBI for that matter in the banking side. And in the NBFC side, our preference is more toward the larger name again, Bajaj Finance. So yeah, when the macro environment is not that great, our preference is more towards the safer bets rather than going into the, going down to the curve and let's say going into tier 2, tier 3 names.
Okay, I just want to have a follow-up question there. Ajit, give us a second. We should look at rates as well, the pre-open. So Axis is taking a knock of about 7.5% in pre-open. Let's get the rates up. We should look at Wipro as well. Remember the question I asked Rima was, with Wipro, is the glass half full or half empty? And Rima said it's a glass half full, Surabhi. And that's what the stock is indicating right now, because the deal wins and the commentary for the second half are very, very promising, though the first quarter has been slightly soft. So Wipro is looking good. And Axis is still down about 6.5%. Just to complete that point, Ajit, you said that you will not go down the curve too much. Looking for tier 2, tier 3 lenders. Just expand on that, because a section of the market is doing exactly precisely this.
Yeah.
And, stocks like whether it's a Bank of Maharashtra, look at the institutional buying in RBL Bank, names like AU Small Finance Bank. So there almost seems to be a race to find a mid-cap or a small-cap financial stock that can give you super returns, because the big banks are not moving. Why do you think that this is not the right way to go? And is there anything that you like in tier 2 financials?
No, so we have few, preferences at tier 2, tier 2, tier 3 financials. The only common thread in our picks is we are preferring, players where there are not much asset quality concerns. Growth and, margin is actually second or third variable that we are looking at. It's the first asset quality that, trend that we are focusing on. And in that regard, City Union Bank in mid-cap, we prefer. DCB Bank we prefer in the banking side. In NBFC side, our preference is to more toward the housing finance company, like such as, PNB Housing Finance, Aadhar Housing in, let's say, affordable housing players. And as I said, the common thread among all of them is the asset quality concerns are not there that much, as compared to some of the other riskier name. While market is chasing growth, and that is why getting into this all those tier 2, tier 3 names. But my sense is in FY26 credit cost for all the lenders is going to be much higher than the expectation, and even more so for the tier 2, tier 3 names who are exposed highly toward this unsecured loan and let's say, MFI loans. And that is why even in tier 2, tier 3, we remain highly selective.
Oh, okay, that's a different view. Haven't heard that too frequently in the marketplace. That this could be a year where we need to watch for credit costs. Interesting one, Ajit. We'll remember that for sure. Just to wrap it up, a quick call on SBI. Mega fundraising exercise underway. What's your call?
So we like the name. So while 25,000 crore looks, high in terms of the absolute quantum, but looking at the balance sheet size, it's a minuscule for them, to be honest. I mean, there's not much impact on the CET ratio. Hardly 15-20 basis point positive impact is there on CET ratio. But capital raise or no capital raise, we do like this bank from longer term perspective. Yes, there is a margin pressure which is going to come for SBI as well. But all said and done, the entity is printing more than let's say 15-16% ROE. And anybody who is having, let's say, longer time horizon of 2 to 3 years, SBI is, one of the more safer and, preferred bet.
Okay, all right, got it. So stick to big banks. That's the advice coming in from JM Financials. Good conversation this morning, Ajit. Thanks very much for joining in.